Part 4 of 4, financing your home purchase with the USDA loan program. Everything you need to know about financing your home with that program, the USDA loan program. This is a long-awaited video, and I wanted to make sure that I pack as much as I can in this video. Another blessed day in South Florida. I'm Getchin Sherry, founder of Homesnatch Realty, and I thank you for your continued support. And as always, please subscribe, comment, like, and share the video if you find value and you think someone else may find value in it. This video is part 4 of a 4-part series where I discuss everything you need to know about financing your real estate transaction. As you know, 90% of all homes that are purchased in the U.S. is purchased with some kind of financing. My focus with these videos is to provide you with detailed information about each program. In part 1, Part 2, and Part 3, I discuss everything you need to know about financing your home purchase with the FHA, the conventional, and the VA loan programs, respectively. In this video, Part 4, I will discuss everything you need to know about financing your home using the U.S. Department of Agriculture, which is USDA World Development Guarantee Housing Loan Program. The USDA sets basic eligibility requirements. To be eligible for a USDA home loan, U.S. citizens or legal permanent residents must meet these basic requirements, which include income, credit, property usage, home location, and other requirements. Now, each one of these factors play an important role in the USDA mission to help provide safe housing to low to moderate income families. An in-depth discussion about the USDA loan program. So let's dive right into the details. As always, I advise you to talk to your lender or a mortgage loan professional to determine which home loan product that best fits your specific needs, your specific circumstances. Now, the question becomes, what is a USDA loan? The program is more commonly known as USDA Home Loan. However, its official name, as I stated above, is the USDA Single Family Housing Guarantee Loan Program. This mortgage program is also known as Section 502 Direct Loan Program, or Section 502 loan, or Section 502, most people refer to it, Section 502 loan, which refers to Section 502H of the Housing Act of 1949, which is the law that makes it possible for the USDA to summarize. The USDA home loans are loans backed by the U.S. Department of Agriculture as part of its World Development Guarantee Housing Loan Program, low to moderate or average income. The USDA loans offer financing with no down payment. Also, it offers you below market mortgage interest rates, so low interest rate as well, and yes, at a reduced cost for your mortgage insurance. As you know, if you buy with an FHA, you will need to get insurance. If you buy with conventional, you will have to get insurance. because if your equity is less than 20%, conventional loan, you will have to get MI insurance. The program is designed again to help single family home buyers with low to average income and to stimulate growth in low populated area. In other words, in rural areas. However, it's not limited to those. There, you'd be surprised where you can use the USDA home loan. It doesn't have to be a farm area. It doesn't have to be rural. It just simply have to be low populated. But there are ways you can find how to do that. We'll get to that shortly. USDA home loans provide, as I stated, 100% financing. Unlike the FHA loan program, which provides you with up to 96.5% LTV, meaning you have to put down 3.5% with an FHA loan. The USDA loan offers home buyers up to 100% financing. However, you can lower your monthly mortgage loan payments or potentially qualify for a larger loan amount if you elect to make a down payment. USDA home loan employment history requirement. As with all government qualified mortgage loan programs, USDA guidelines require the lender to verify your ability and your desire to repay back the loan, meaning your lender will consider your ability and willingness to meet your debt obligations. Therefore, you must be able to demonstrate to the lender that you have a stable and dependable income, as well as an acceptable credit risk, that you are credit worthy. Your lender will verify your credit and your employment history going back to 3 years. However, 2 years is what they will consider, the most recent 2 years. However, any employment changes is still acceptable if you can provide, as long as you don't have an extended gap or any long extended gaps in employment that cannot be explained. If you are a newly employed individual, meaning you recently were employed, well, even that might provide you your lender might provide you some exceptions if you are a recent college graduate, and you may be able to get an exemption from the 2-year employment requirement. Income qualification. Well, here it is important to remember that the USDA Home Loan Program was created to help people with low to average income. So therefore, it is not designed for people to purchase home for investment purposes, for example. Therefore, your home must be for your primary residence. The basic guidelines are to ensure that homes are accessible to those who need them most. So if you want to buy a home for investment, the USDA is likely not going to be a good fit for you. USDA home loan income requirements are based on your local region, meaning it varies from state to state. The size of your household to determine whether you are eligible. If your income is eligible for the USDA, your lender will consider 4 income calculations. Those 4 income calculations, and I'll go over them in detail, will be your annual housing income, your adjusted annual housing income, your USDA home loan income limits, and your repayment income. Each one of those have a different meaning. So let's address number one, your annual housing income, meaning your lender will consider your annual income for the household, meaning every adult wage earner in the household, even if they're not a co-signer and they're not on the loan. They will take the projected income from every earner in the household. Now, your adjusted annual household income, meaning your household income after all qualified deductions are subtracted. Your household qualified adjusted income is compared to the median income in your local region. This is used to determine if you meet the program's income restrictions. To satisfy USDA's income requirements, the adjusted annual income for your household cannot exceed 115% the median income in your area. Simply means your household, to qualify, your household cannot make more than 15% above your local median income. Now, number three, USDA Home Loan income limits. Remember, again, the USDA income limits are based on your location, the size of your household. When determining your household USDA annual income eligibility, the total income earned for every adult member of your household will be considered. Currently, the USDA income limits are based on the following criteria. If your household has 1 to 4 people, your annual income limit cannot exceed $103,500. That is as of January 1st, 2022, and I am shooting this video in 2022. Yes, it may go up in 2023. If your household is 5 to 8 people, the annual income for your household cannot exceed $136,600. Again, please note the USDA annual income limits are higher in areas where the cost of living is exceed the national average, such as Alaska, Hawaii, and perhaps California. Also note that your annual income limits are subject to change annually, as I stated above. You can use the USDA eligibility map to determine if you meet your local income limits. So you go to USDA and use their map to determine what your limit income is in the area. Number 4, repayment income. This is the income the lender will use to determine or to evaluate your debt to income ratio, also known as your DTI ratio, and affordability, meaning your lender will use your income and the income of any co-signers to evaluate your DTI ratio and determine if you can comfortably afford to repay this loan. Your total debt cannot exceed your gross monthly income or GMI by more than 41%, meaning that's the maximum. Now, Some, it depends. There are some other factors that your lender will take into account. So there are some other factors, but ideally you want to be below 41%. It may be possible, again, to go higher than 41% DTI. However, a higher DTI ratio may result in a stricter underwriting process. Your lender will use all verifiable income you stated in your application for loan qualification purposes. Your lender will request 2 years of your federal income tax return, and you'll have to provide 30 days pay stubs so they can evaluate your employment. Note, there is a difference between USDA qualifying income and the repayment income. The qualifying income is used to ensure you meet the income requirement, the limit. In other words, you cannot make more than a certain amount. Whereas the repayment reflects your ability to repay. So don't confuse those two. Other streams of income. While it is important to determine your household annual income, often certain income streams tend to present some kind of challenges. And yes, the USDA provides some guidelines how to handle those common income streams if they are applicable. So for example, cash on hand, cash in your bank account balances. Your lender will consider your cash assets, bank account balances. Therefore, your lender is likely to verify any unusually large deposit into those accounts, any account that you're holding. Farm income. Generally, your lender will consider the net operating income, or also known as NOI, when calculating your household USDA annual income eligibility. Over time, in seasonal employment, your lender will use historical data to calculate your qualifying income if your income fluctuates from year to year or from month to month. Meaning, seasonal income that were earned in the last 2 years may be projected for your upcoming year. So those are things you should be mindful about. Business income. Your lender will consider your NOI, your business NOI, when determining your household USDA annual income eligibility. If your business reported a net loss, of course, that will count for $0. However, all deductions for verifiable, unreimbursable business expenses will be considered. Income producing properties. Your lender will use historical tax filing data for income producing properties to calculate your USDA qualifying income. So therefore, you should be able to account for the NOI as well. Also note, other deductions may factor into your adjusted annual income. Now, common USDA home loan exceptions. While the income for all adults in your household are considered, there are some exceptions. The following type of income are always excluded from your USDA annual calculation, i.e., income that are earned by a minor occupant in the house, income that are earned by a full-time adult student that exceed $480. Section 8 payment or payments from other housing assistance programs. One-time inheritance, capital gains from investment, or an insurance payout are also included. Lastly, income earned by a living aid. So if you have a person living in your house to provide assistance to someone who is in medical need, well, that person's money will not be included because that's not, you paying that money. That's an expense for you. Qualifying deduction to reduce your annual income. Now, notwithstanding everything I've stated before, the USDA Home Loan income qualifying factors the guidelines allow for 5 basic qualifying deduction that you can use to reduce your annual income. So when determining your household USDA annual income eligibility, your lender may consider the following deductions. So child care expenses. Your lender may deduct unreimbursed, meaning you didn't get that from another source. So unreimbursed child care expenses for children under 12 years of age if putting the child in daycare or child care enable a family member to gainfully be employed. Dependent income deduction. Your lender may deduct $400 from the annual income of if the head of household or the spouse or another mortgage loan co-signer is disabled, or if the person is 62 years or older. So if the person is an elderly, they can deduct up to $400 from that individual annual income. If the person is the spouse, if the person is an adult that lives in the property, if the person is disabled, or if the person is 62 years or older. Now, medical expenses deduction. Your lender may deduct unreimbursed medical expenses that exceed 3% of the annual household income for elderly household members. In other words, if someone in the house has medical expenses that exceed 3% of the annual income of all the people in the house, well, that amount may be deducted. Household members with disability deduction. Your lender may deduct unreimbursed expenses for care of disabled persons that exceed 3% of the annual household income. Now, USDA Home Loan credit requirements. Now, you will hear quite often people will tell you that the law does not have any loan requirement, any credit requirement. Yes, that is true. The law does not provide a credit requirement. However, keep in mind, the banks will make you the loan. The USDA will back that loan. So, the USDA guidelines do not have a minimum credit score. However, most lenders require a minimum median credit score of 620. If your median credit score, so usually there are 3 credit reports that will be pulled. So the median, meaning you have one low, one high. The one in the middle is what we refer to as the median. So if that is 640 or higher, you are eligible for the USDA automated underwriting system. Lenders prefer to use the USDA guaranteed underwriting system, also known as GUS. to streamline the underwriting process. It makes their job a lot easier. However, the USDA UGS program, the automatic underwriting program, requires, for approval, it requires you to have a credit score of 640 or higher. And you cannot have any outstanding federal judgments. You cannot have any significant delinquents. I will discuss those further. Now, if your credit score, your median credit score is below the 640, so you are subject to manual underwriting, meaning you may have to satisfy a more stringent underwriting process. Now, to determine your credit worthiness, your lender will evaluate your length of credit history. They will evaluate your credit score, your repayment patterns, and your credit utility, or your credit availability as it compared to your credit usage. Your last 3 years credit history will be evaluated. However, as I stated before, preference will be given to the most recent 24 months because those are more relevant and they reflect more of your current circumstance. If you have not established a sufficient credit history, you may still be eligible for the USDA Home Loan program, depending on your lender's policy. Your lender will verify your credit using alternative sources, such as, do you have any rent payments history, any utility payment history, meaning bills, light bills, cable bills, phone bills, any insurance payment history. Your lender may take those things into account to satisfy your lack of established credit history. Now, credit score validation. Your credit scores are valid if your credit reports show at least 2 trade lines, meaning you have at least 2 open and active accounts for the last 12 months and the last 24 months. So if within the last 2 years you have 2 that are active and currently open and they are 12 months old or older, you are good to go. That is as of the date your credit report is pulled. Regardless of your credit score, USDA must provide a final loan approval after your lender clear your USDA home loan application. So even though your lender will provide you with the approval, USDA must verify and they must approve that application. Now, these are some unacceptable credit indicators. Once your loan approval officer has reviewed your credit reports, a determination will be made on your USDA home loan application. Based on that analysis, if your credit history is acceptable, your USDA home loan application is likely to continue through the approval process. If your credit history is unacceptable, your USDA home loan application will be denied. The following are indicators of an unacceptable credit profile, but keep in mind they are not limited to just those. So let's say little to no credit history. For installment accounts, you cannot have more than one 30-day late payment in the last 12 months. For revolving, i.e., so installment debt means a loan, like a car note, like a bank loan, but revolving mean credit lines that are revolving. For those, you cannot have more than two 30-day late payments in the last 12 months. Outstanding collections without a payment plan or irregular payments, or if you pay them in full within the last 6 months. Now that's a red flag that will tell them, hey, you want to buy a house, so now you're paying off your debt. Now, it is acceptable to have a payoff as long as you have a prior payment history. So you were making payments for a period of time, and then you decide to pay the balance. That's acceptable. Rent payment. You cannot have 2 or more 30-day late payment in the last 2 years. Now, in that case, some exception may apply. You may want to talk to your lender to determine if you meet those exceptions. Outstanding tax liens. You cannot have any outstanding tax liens, and you must not have any foreclosures within the last 36 months. That is within the last 3 years. Now, USDA Home Loan property requirement. We're almost done. I know it's long. USDA Home Loan property requirement. Now, keep in mind, the goal of the USDA Home Loan program is to provide safe and sanitary residences for low to moderate income households that are in less developed areas. To achieve this, the USDA sets basic property requirements that protect home buyers and lenders. Now, if you are eligible, you may purchase, build, refinance your home with an USDA with a USDA home loan. However, let's go. The program can be used for, you can buy, like I said, refinance, built any single family home in an area that is USDA eligible. So the location must be eligible for a USDA loan. You can use the USDA eligibility map again to determine if the property you wish to purchase or if your local area is considered a USDA eligible area. Eligible properties include new constructions. You can buy condos, townhouses. You can buy modular homes, manufactured homes. You can do short sale. You can buy a short sale. You can buy a foreclosed home. Although you do not have to be a first-time home buyer to use the USDA loan program, there are some restrictions. For example, you cannot buy an existing mobile home with the USDA loan program. The home must be used as your primary residence, as I stated previously. The home cannot be used as an income-producing property, i.e., you cannot use it as an investment property. The home must be habitable, meaning you cannot use the USDA home loan program to rehab a house. So the house got to be turnkey. You got to be able to live in the property once you close without any rehab work to the house. The home must have adequate utilities such as water, power, electricity, potable water, wastewater disposal, and if you are building your home, the site must have a direct access to a street, a road, or a driveway. I hope if you made it this far, you must have been interested. This is a long video, but I know you waited for a long time for it, and I really wanted to pack everything in this video. Click and subscribe. It is the logo, the Home Snatch Realty logo. click there to subscribe. And I will attach part 3 to this video. So if you want to watch the other ones, you can do so. And it will help if you would click the like button, comment, share, and yes, keep your questions coming. I will make the time to answer them, and I'm even in a more comfortable area. Hopefully, this is not as distracting. Okay, so thank you again. Until next time, have a blessed and productive day. Thank you. This was a long one.